Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. It's Thursday, not Monday. And the reason we're recording on Thursday is because we have a big theme, defense.
And of course, because what happened Monday disrupted everything until today.
So let's talk about it now. The biggest stories in the more than $15 trillion global ETF industry. President Donald Trump cheers NATO's pledge to spend 5% of GDP on defense. In just moments, we'll speak to Cinthia Murphy on why the sector remains one of the best performing themes in ETFs this year.
Then we'll take a deeper dive into the sector with Tony Bancroft. He is portfolio manager and defense analyst at Gabelli, whose ETF invests in aerospace companies.
And JPMorgan is further cementing itself as the fastest growing active fund manager with a newly launched ETF focused on junk-rated bonds. All of that and more coming up. We will be speaking with Eric Balchunas in the next block, but I'm looking at flows today, the week that was and that is still going. Let's take a look at where the money is moving into to start. The flows look a little bit weird, and you'll see that when we look at the outflows. But when we start with the inflows, we have IVV up front taking in $18 billion. That to me screams model, which we'll get to. SPY also taking in a big chunk here, taking in nearly $11 billion. Then you have some mid-cap action as well. A lot of BlackRock funds, a lot of iShares funds. Let's take a look at the outflows because it's a lot of Vanguard in there, which makes me think that maybe there's some model portfolio tweaks going on because up at the top you have VU losing about $6.6 billion. Then you have their mid-cap ETF losing about $4.4 billion. Remember, in iShares, mid-cap ETF took in a big sum of money. And then you have some more Vanguard funds as well. So who knows, truly? This could be model movement, but what we do know is that defense is hot when it comes to this market. You take a look at this chart from our friends over at Bloomberg Intelligence. Global defense, that's in blue here, taking in 7 billion euros. We're taking a look from the European side, and you can see that inflows really accelerated both into global and into European defense starting in about February. We know it's a very fraught geopolitical landscape right now, and that has translated into big flows into defense funds. And as you can see up on the further end of that chart, that continues to just grow and grow, Scarlett.
Yeah, pretty dramatic acceleration in the last couple of months. Katie, thank you so much. Joining us for our conversation now is Cinthia Murphy. Cynthia is investment strategist at TMX VettaFI. Cynthia, great to see you. When Katie talks about the money that has gone into defense companies, clearly it's tied to the news flow, but I'm wondering, is the defense sector more of a growth play or a defensive play right now?
Hey, Scarlett, what's interesting is defense really is an industrials play, which if you look at a lot of these portfolios, are very heavy industrial names. Now, the ones that are really doing well also have a big aspect of technology investments because a big part of this defense spending conversation has focused on that artificial intelligence, the drones, the cybersecurity part of the defense conversation. So it's a portfolio that it tends to be a mix really, but mostly a little more defensive for being more industrials, but it's adding that risk in the technology names. It's been a phenomenal ride for defense as a theme. It's always fun to watch when a theme really sticks and hits big, and 2025 has been the year for these ETFs.
And it's funny, too. We talk about false dawns when it comes to European stock performance all the time on this show in explaining why maybe you haven't seen a ton of inflows into European equity ETFs, even though you do have this outperformance versus the U.S. That's not necessarily the case when it comes to European defense ETFs. You are seeing interest, you are seeing demand and that money flow. So it's kind of funny to see it buck the trend of the overall region.
Yeah, it was a theme where domestic bias hasn't been a really, really strong thing. However, if you look at some of the best performing defense ETFs this year, I think at the top you have a fund like EUAD, which is, Europe defense. It's all these names like Rheinmetall, which is a German arms manufacturer, or Safran, which is a French firm. That fund has a phenomenal performance, and it has picked up about $800 million, which is a really strong year. But then you look at a Shield from Global X, where 50% of the portfolio is U.S. defense names, and that fund has picked up about $1.5 billion. So I think the theme has really shown its potential and its resilience, especially in European stock market and European names. But you have folks playing a more global approach, keeping some of that U.S. exposure as well. in funds like Shield. I mean, VettaFi has the index underpinning NATO, the Future of Defense ETF, which is a European listed product. And that fund this year, it has become a $2.5 billion fund. So we're seeing that demand also from international investors really looking to buy this theme. So it's just really phenomenal.
Is this theme, though, limited in terms of the number of companies that really are key players in the industry? Meaning you're not going to see a lot of small companies that are in this industry the way that you would in other sectors. And I wonder if, as a result, you once you bid up a couple of these names, whether they're European or American, you're kind of done. You can't do much more than that.
Yeah, I guess it's a valuation question. Can these firms get too expensive to really deliver a lot more upside potential? I think it would depend on how much geopolitical heat it remains a theme. And I think this stance the U.S. is taking now of, hey, Europe, you're on your own. Invest up here and build up your own infrastructure for defense and your own systems, because we're not just going to buck that bill anymore. I think that actually gives a lot of upside potential still, because there's a lot of investment that needs to happen. And so it would be interesting to see at what point it's a little bit could be the Mag 7 story. At what point are we overpaying for semiconductors and the big, names? That could happen. I don't know where that mark is. I think it may be too early to tell.
Scarlett, you mentioned that you don't really see a lot of small defense companies. And on that topic, let's talk directly about the little guys, Cinthia, because I'm taking a look at the notes you sent over to our producers. You said that this week specifically, you're looking into small cap ETFs. Why is that? Why this week, and why small caps?
So, I mean, small caps in the U.S. market have been kind of a dog this year. Nobody has loved them. Their performance has been bad. I think they remain negative year to date. But if you look at the last couple of weeks to a last month, they have turned around in performance, and performance is positive, 4, 5, 6, 7%. So I'm just kind of curious, like anytime you see a change in the small cap space, is this a signal that are we growing a little more confident on domestic growth? Are we believing that policy and regulation, all the, big, beautiful bill, all these things that are coming up, are they going to support this space a little bit more? But I think it's early to tell. And if you think about the rebound we've seen in the broader stock market, large caps have also rebounded. It could be that small caps are just riding that wave. I think it's been really noteworthy, the performance of small caps also in the international space. European small caps are up like over 20% this year. Have anybody paid attention? I'm not sure. I just noticed recently. It's been a space that we don't really pay too much attention, but there's really strong performance this year in the international small caps. So it's just a space that I'm starting to look a little more closely, because, small caps are always an indication of something coming. And I just wanted to figure out what is it that they're telling us.
I like that. I like that idea that noticing when small caps outperform just means there's a shift and we need to pay further attention and dig into it. You mentioned small caps in the U.S. have been dogs this year. They've been dogs for the last 3 years, the last 5 years, the last 10 years. So basically most of the time, except over the past 1 month. So as a result, Cinthia, it feels like they can't be long-term holdings. They're more just a timing situation where you dip into it on a relative basis compared to big caps.
It depends. I mean, there's always the diversification argument. You got to stay diversified. Like we talk so much about concentration risk on the big, large caps. Owning small caps is a diversifier. I also think it's important to look at the disparity. If you look at the performance of a Russell 2000 ETF like IWM versus you look at the performance of a small cap value active, a VUV, for example, from American Century, I mean, that fund is up almost 20%. In the European space, even higher. I mean, there's really strong performance when you go active. There's really strong performance when you go very tactical about which small caps you're actually owning. So it's a segment that I think can deliver. You just have to, be a little more hands-on, at least for now, unless you're just going to buy the diversification card and own all of them and see what happens.
A little bit more hands-on when it comes to the small cap. Cinthia, it's always great to speak with you. That is Cinthia Murphy of TMX VettaFi. Now coming up, warning of private credit fraud and why the JPMorgan asset management CEO thinks that public high-yield debt is the way to go over private. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with BlackRock debuting its Texas ETF. This is a fun one. It's going to include 200 companies across Texas's economy. That is a hard word to make plural. The expense ratio is just 20 basis points. The ticker is fun. It's TEX. And it really gives investors a way to buy into the state's growth. That is the stated mission. But we know Larry Fink has been on a charm offensive when it comes to Texas. But in any case, let's move on. Let's talk about private credit a little bit in the form of PRIV, State Street's private credit ETF, first of its kind. This was hotly anticipated among industry watchers, including the anchors of this television show. Didn't necessarily translate into inflows. You can see that it only took in 2 inflows and then nothing until this week, Scarlett, taking in $15 to $16 million, third ever inflow and a record for the fund. That is a great question. What did change? I'm not quite sure. But let's also talk about JPMorgan. They launched the JPMorgan Active High Yield ETF this week. This one is really interesting. So 80% of the portfolio to junk rated bonds, launching with a $2 billion anchor investment. I tried to get them to tell me who it was. They wouldn't, but they said it's one of their most sophisticated and long-term relationship.
That narrows it down.
There you go, with an institutional client. So we'll see. But we know that JPMorgan has been on an absolute tear when it comes to the active ETF space and the active space overall, including mutual funds. So really, this is just another way that they're cementing their legacy there.
All right, so let's talk a little bit more about this, about JPMorgan Asset Management with our very own Eric Balchunas. Eric, what is JPMorgan Asset Management's secret sauce? What have they figured out better than other issuers that has basically supercharged them in the last year or so?
Yeah, I think, the guts to get cheap. They are selling JPMorgan. If you're an advisor, think of an advisor in Nebraska. You can get your client JPMorgan Active Management for a Vanguardian fee, right? That is very high value proposition. It helps the advisor show some value add. It doesn't even need to have the fund outperforming. It's just, hey, look, it's a great fund. A lot of their funds are a little on the conservative side. You're not going to have any crazy negative years on these funds. JEPI and JEPQ are 2 good examples, and their bond funds. They're on the conservative active side, so advisors trust them. You get a lot of value. And in the case of their equity, they're also doing options overlay, so you get more legwork. It's a pain to write options. It's just got to keep up with it. So they do a little legwork for you. You throw all that together, it's a high value proposition for advisors in particular who are looking to add value for their clients above and beyond, just buying like 2 60/40 ETFs. So I think they've really tapped into it, and they also got into the ETF business in full 5-6 years ago. And a lot of their peers just are now entering.
Yeah, I spoke to JPMorgan Asset Management CEO George Gatch about this, and he was clear that ETFs are not a sideshow for them. They are very serious about that arm of the business. I want to talk a little bit about this seed investment. $2 billion. That is a huge chunk of change. This immediately vaults this specific ETF up the ranks in terms of who's the biggest out there when it comes to active junk funds. When it comes to seeded ETFs, tell us a little bit about what the decision tree on the issuer's part looks like. I mean, why would you want such a large anchor investment when you get out the gates?
Oh, it's perfect, because at $2 billion, it already looks like there's a party going on. I mean, assets are marketing, and if you can get an anchor tenant like that in there, you're already profitable. I mean, by far. $2 billion is enormous, by the way. I believe this is a record for a bespoke client. And, JPMorgan, this is one of the benefits. They have I know this isn't their own money, but they do have a private banking unit that's huge, and they're very connected, right? They've got a lot of institutional clients that they can pitch this stuff to. So this ETF is now the second biggest junk bond active ETF on the market, and there's 52. So to begin life at the number 2 spot is amazing, and just shows, it's good to have a big firm with, friends in high places. But it's also, again, you look at the fee, it's a decent fee for JPMorgan's brand, active management in a space that people do like active, which is high yield. But yeah, that's an enormous amount. It's good if you can get it. It's like a starter log.
Yeah, I will say it's not like starting life on third base. It's like being born with a home run. It's interesting, though. The point was made in the press release, Scarlett, that when you start with $2 billion, you launch with a fully invested portfolio or very close to it. You don't need that time to spin it up.
Absolutely. You have your credibility there already. Eric, thank you so much. We'll see you on Monday when ETF IQ comes back. In the meantime, still ahead, we're going to drill down further into the defense sector with Tony Bancroft of Gabelli. He manages an ETF in the high-performing sector next. This is ETF IQ. This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down where we focus on one ETF. And in the hot seat this week, we have GCAD. This is a Gabelli fund, commercial aerospace and defense. And this is an interesting one. Obviously, we've been talking about how defense has turned into this bright, shiny object. And if you take a look at the assets in this fund, they're pretty small, about $9 million, but they've been growing. It has an expense ratio that says 0 right now. That's because fees are waived up until the first $25 million. Let's take a look at the portfolio, though. This is exactly what we're talking about. Up at the top, you have Boeing, as you might expect. Then you have Howmet, Spirit Aerosystems. The list goes on. You have Lockheed Martin in there as well. I want to get to performance because that's when things get really exciting. Over a 5-year basis, it's pretty much neck and neck with the S&P 500, slightly outperforming to the tune of about 2 percentage points. But let's zoom in and let's take a look at the year-to-date performance, Scarlett, because, again, like I said, this is where it gets really exciting. You can see GCAD is up 19% on a total return basis. You compare that to the S&P 500 up about 4.3% on a total return basis. Of course, we're seeing this big outperformance because there's a lot of unrest on the geopolitical landscape, but that has translated into some pretty hefty returns for GCAD.
Absolutely. All right, Katie, thank you so much for setting that up. Let's bring in now the manager at Gabelli who oversees this fund, Tony Bancroft over at Gabelli. Tony, it's good to speak with you. And of course, no shortage of headlines here driving interest in defense stocks overall, whether it was the weekend bombing by the United States on Iranian nuclear sites, or it was the NATO pledge to increase spending as well. Let's just stick with NATO spending for now, because that's kind of more of a long-term play here. Assuming NATO follows through on its pledge, what does the extra spending actually look like? You've looked at the numbers.
Yep, sure. Yeah, and great to be back, Scarlett. I think the simple number is this. Global defense spending is about $2.7 trillion. Of that, NATO's $1.5 trillion. Of that, the United States is almost $1 trillion. If NATO were to go to 3.5% of GDP of military equipment spending, is which they've targeted, that would be an extra $500 billion, or about a 33% increase in annual defense spending for NATO. The U.S. is pretty much at an export basis. It's probably 63% or 65% of what Europe buys. So U.S. is going to be a big participant in the increase in defense spending. Obviously, Europe and Canada have been the laggards in defense spending in NATO. So I think that $500 billion is a pretty sizable number, and it's significant. It means a lot for the defense industry in general.
So you must have been psyched about this NATO summit, I have to imagine. I do want to talk about your top holding, and that is Boeing. Boeing, of course, is related to the defense theme, but it's very much an idiosyncratic story as well. We know that Boeing has had its fair share of issues. And with that in mind, I mean, how comfortable are you with it that you have this big weighting to Boeing in your portfolio?
Sure. Yeah. Katie, I'd say, Boeing's issues, it's probably more complex than I think the general populace understands. I'd say in this most recent event, you got to remember, essentially half the fleet is either Boeing or Airbus planes. That and every other second a Boeing plane takes off. Boeing is the gold standard of safety. It's the safest aircraft overall by far, just based on a history weighted basis. The FAA in itself is 51% weighted to Boeing. So I think when you talk about Boeing and safety, they're pretty much synonymous, and everything there's a lot of idiosyncratic events that have happened in the past. And but as far as the Air India I think it's still, there's a lot of speculation out there. They're supposed to have a preliminary update in about a month, and we're going to find out more. The reality is that plane has 5 million, that airframe has 5 million flights, 30 million hours, and it's never had a whole loss until unfortunately, the events of a few weeks ago.
Yeah.
So I think if you're going to point that out, that's one thing. And then there's a whole other piece of Boeing. There's this huge unconstrained demand, decade-long backlog of aircraft, selling into a 40,000 plus plane tailwind over the next 20 years. And Boeing's going to get their fair share, if not more. They have a great plane. The MAX is still the best narrow body as far as efficiency and capability. It outperforms, and they're going to sell a lot of those planes coming into the future. And on top of that, they have a great defense business. The GBU 57 mass orders penetrator is a Boeing weapon. So they make a lot of great systems, and they're going to do very well.
Good reminder of how multifaceted that company is. Tony Bancroft over at Gabelli, thank you so much. And of course, you can read about this drill down plus the latest in the ETF industry. Katie?
When you subscribe to my weekly ETF IQ newsletter, that is Bloomberg.com/ETF IQ newsletter. We're going to be back on Monday at our normal time of 12 p.m. Eastern if nothing huge happens. And Eric Balchunas should be back as well. Maybe he can start doing Go with the Flow again. That would
You're looking forward to that, aren't you?
I am. That does it for Bloomberg ETF IQ, the TV show. I'm Katie Greifeld along with Scarlett Fu, and this is Bloomberg.